Hello all, and thank you for joining our investor update. Today, I am pleased to present World Engine Portfolio and Investments Results and Analysis covering 2017 through to December 2022. This 6-year period tested markets with multiple cycles, and all the while, our fund's objective from the start was clear. Achieve long-term capital appreciation with controlled volatility, specifically aiming to outperform the S&P 500 as our primary benchmark. We pursued a focused investment theme centered on emerging technologies, advanced semiconductors, and digital platforms, balanced by strategic exposure to defense and aerospace companies for stability. In essence, we adopted a barbell strategy, pairing high-growth technology equities with geopolitically resilient defense tanks to capture upside while mitigating downside risk. By sticking to these forward-looking vision and active management discipline, the World Engine Portfolio navigated a tumultuous period with conviction. Let's delve into the economic context and see how our strategy played out. Before we discuss performance, it is important to understand the macroeconomic backdrop that influenced our results. Between 2017 and 2022, the markets experienced several major disruptions, including the following. The US and China trade war in 2018 till 2019 involved heightened trade tensions and tariffs between the world's two largest economies, which led to increased volatility globally. For businesses exposed to these levies saw profitability squeezed, dampening equity valuations. In fact, American companies collectively lost an estimated $1.7 trillion in market capitalization directly due to the trade war, which shaved roughly 1.9 percentage points of market growth by the end of 2020. Our portfolio was not immune. Some of our tech holdings with global supply chains, especially our China-focused position in Alibaba, faced headwinds during this period. We managed through it by staying committed to our long-term themes, confident that the innovation driving our tech names would outlast transient tariff pressures. In early 2022, the COVID pandemic triggered an unprecedented market shock. By March 2022, global equities plunged as investors grappled with uncertainty, and suddenly liquidity was gone from all markets. Like virtually all other funds, World Engine saw a sharp but short-lived drawdown due to the initial outbreak. We responded with robust risk management strategies, stress testing our portfolio and ensuring adequate liquidity as part of our active management approach to navigate the turmoil. Importantly, the pandemic also accelerated key trends that our portfolio was positioned for: remote work, cloud services, e-commerce, and digital transformation. As the world moved online, firms in our technology bucket, such as Microsoft and their cloud business, and NVIDIA's data center chips, experienced surging demand for digital solutions. This accelerated tech adaptation provided a strong tailwind for our growth holdings when markets rebounded. In late 2021 and into 2022, the market environment shifted dramatically. We saw soaring inflation, at one point the highest readings in 40 years, forcing central banks into aggressive interest rate hikes, effectively ending the era of near zero interest rates. This pivot towards tighter monetary policy sparked broad global market downturn in high valuation growth stocks as recession fears grew. Compounding these challenges, Russia's invasion of Ukraine in early 2022 led to spikes in energy and commodities prices, furthering global inflationary pressures. Markets reacted with heightened volatility, particularly in sectors directly affected, like energy, but also in growth equities sensitive to interest rate hikes. Our World Engine Fund had to evaluate its exposure to inflation-sensitive areas, considering hedges for commodity price risk. Notably, the war also triggered a blistering rally in defense equities as geopolitical tensions rose, a development that saw our defense positions poised to benefit from. In summary, the latter part of our horizon tested our strategies under stagflation-like conditions: high inflation, rising rates, and geopolitical strife all at once. Through each of these macro events, we maintained a disciplined approach. We did not drastically change our strategy, but we did lean on our portfolio's inbuilt hedges, and tech holdings drove growth in expansionary times, and defense holdings provided ballast and protection during crisis. The balance was crucial to our fund's resilience, as we will see in examining our portfolio performance. To achieve our objectives in these conditions, World Engine's investment portfolio was constructed as a concentrated high conviction basket of stocks straddling two primary themes. On the growth side, we invested in digital disruption and semiconductor leaders. Key positions included companies like Nvidia, AMD, benefiting from the GPU boom and semiconductor cycle, as well as Microsoft and Alphabet, also known as Google, dominating from the cloud computing, software, and data performance of the market. And Meta, for digital advertising and social connectivity. Alibaba allowed us to capture some of the Chinese market's internet and e-commerce growth. We also held Intel in semiconductors, albeit at a smaller weight, as part of our belief in the semiconducting and computing theme. Counterbalance that, on the stable growth side, we allocated capital to defense and aerospace firms with durable cash flows and lower market beta. Notable holdings were Northrop Grumman and L3Harris Technologies, both major US defense contractors, along with Textron, which spans aerospace and defense products. Booz Allen Hamilton, a government defense technology consulting firm, was also included among the investments. These companies tend to be less volatile and often more inverse to the market than high-flying tech during significant market stresses, making them ideal hedges. This barbell portfolio of roughly 11 stocks was weighted intentionally. Approximately half to two-thirds of the capital was in high-growth tech names like Microsoft, Google, and Nvidia, etc., each initially sized for the low to mid-teens as a percentage of the portfolio, and then the remainder in the defense-oriented names, generally high single-digit ratings each. By January 2017, the firm had fully invested with an initial value of $100 million allocated throughout each of these positions. Throughout the 6 years, we largely maintained these core holdings, making only minor adjustments. The success of this composition will be evident as we move forward to our portfolio analysis. Now we turn to the fund's performance. World Engine delivered an outstanding result over the 2017 to 2022 period. Absolute firm terms, the firm's initial value of $100 million grew to approximately $319 million by December 2022, representing a cumulative return of 219%. This means the fund more than tripled its value in 6 years. To put that into perspective, if you look at the performance on the chart on the slide, our portfolio's value, the orange line, climbed steeply, far and above exceeding the baseline benchmark performance of the S&P 500. Over the same time period, the S&P 500 index returned roughly 72% in price terms, dividends excluded, versus our 219%, dividends excluded. The S&P 500's 72+% increase illustrates compared to our 219% increase, illustrates substantial alpha generation by the firm, even on a risk-adjusted basis, which we will cover shortly. The fund beat the broad market. In chart comparison, you will notice the S&P in the blue line rose steadily, but much more slowly, whereas World Engine's trajectory was steeper, which we did experience large swings in value, by the way, reflecting our higher volatility. But overall, the growth trend was decisively superior. By the end of 2022, we exceeded the S&P 500 growth by a wide margin, fulfilling our goal of beating the market. It is also instructive to compare our fund to other relevant peer benchmarks in the aggressive tech and defense spaces. One obvious comparison can be made with ARK Innovation ETF, ticker ARKK, a well-known fund representing a basket of disruptive tech stocks. ARK, despite its volatility, returned approximately 180% over 2017 and 2022. World Engine surpassed this performance, which is notable because ARK took on a very high risk profile in speculative tech. Our strategy proved that we could capture similar innovation-driven upside while incurring less extreme volatility. In fact, ARK's huge run up to the crash still left it below our ending value. By blending tech with defense, we delivered a higher total return than ARK with a smoother ride, as we will see in our other risk metrics. On the defense side, we considered SPADE Defense Technologies, an index benchmark for aerospace and defense. The defense sector had a solid run, with an increased defense spending in the late 2022 rally. An index of defense names achieved roughly 125, the index of defense names, rather, which achieves roughly 125 130% cumulative return over the horizon. Our world engine portfolio also outpaced this pure defense benchmark. This is important. It shows that we did not sacrifice returns by holding defense stocks. We still beat a portfolio of only defense stock companies by maintaining a significant exposure to high growth tech. In other words, the barbell approach added value on both ends. We captured more upside than a standalone defense fund, and thanks to our tech weights, we were also mitigated risk better than a pure tech fund. Sorry, I meant on the other way around. We captured more upside than a standalone defense fund thanks to our tech weights, yet we also mitigated risk better than a pure tech fund by having those defense positions in place. We can broaden this comparison with other funds. For instance, T. Rowe's Price Global Technology Fund, an actively managed tech-focused mutual fund, returned about 210% over 2017 to 2022. We slightly edged out even this strong performer. Meanwhile, a traditional aerospace defense fund, such as Fidelity's FSDAX, was up around 125%, which we handily did. And even balanced strategies struggled to keep up with our return. Thus, across the board, and against the broad market, pure tech, and defense benchmarks, World Engine delivered return leadership. This validates our thesis that a concentrated focus on transformative technologies with a judicious pair of stable defense plays can outperform a more one-dimensional strategy. It is worth highlighting which investments mostly contributed to these results. Our top contributors on the tech side included NVIDIA and Microsoft, both of which saw tremendous share price appreciation. NVIDIA, for example, rode the wave of the graphics processing demand. Microsoft steadily climbed on cloud and enterprise software growth. On the defense side, Northrop Grumman was a standout. Its stock roughly doubled over the period as defense budgets expanded, and it executed well on contracts, particularly visible in 2022 when defense stocks spiked. These standout performers helped lift the whole portfolio. Some Legos are more challenged names than others. For instance, Alibaba faced regulatory and political challenges. Intel had competitive struggles which were outweighed by gains by elsewhere within the portfolio. Our diversification and stock selection ensured that success in key positions drove aggregate return above all benchmarks. To give more color on how we get there, let me walk you through the performance timeline of how we manage our volatility. The fund's value hit an all-time high in 2021, at roughly 300% of its 2017 starting value, so about $310 million on the $100 million initially invested. This peak reflected the culmination of a huge rally in our growth stocks. Late 2020 and late 2021 were marked with exuberant markets for tech, low interest rates, and pandemic-era liquidity led to surging valuations. Our portfolio was a prime beneficiary. We saw rapid appreciation, especially in 2021 through to 2023 to 2021, with multiple holdings reaching record highs. It was frankly an exceptional period of outperformance where our strategy really held its strengths. However, 2022 proved to be a challenging reversal. As inflation and interest rate pressures mounted, the market underwent a stark bear phase that especially hit growth and high valuation names. By October 2022, our fund had retrenched roughly 48% below its prior peak. In practical terms, that drawdown was nearly half from the November 2021 high, measured year on year. The portfolio was down about 37% in 2022 from the end in 2024, which is a tough decline, but generally in line with the broader tech sector's correction. This sharp downturn was primarily due to our concentrated tech positions losing value in the face of rising rates. Examples like NVIDIA and AMD saw significant price declines in 2022 as semiconductor cycles turned and investors rotated out of high-growth stocks. Meta also fell sharply in 2022 amid both market trends and company-specific concerns. Crucially, our diversification into defense stocks provided a cushion during this downturn. When our tech names were selling off, our defense and aerospace holdings held firm and in some cases gained ground. The Russian and Ukraine conflict in early 2022 led to a rapid increase in defense spending expectations and a flight to safety in defense equities. This resulted in a blistering rally for stocks like Northrop Grumman, L.V. Harris, and Lockheed Martin. In our portfolio, Northrop and L.V. Harris saw their shares climb even as they fell. Exactly the offset we hope for. This hedging effect softened the blow, while pure tech funds were down far more from peak. For instance, ARK was down 70% from its highs. World Engine's drawdown was less severe thanks to the defense side of the barbell. By the final quarter of 2022, the portfolio had stabilized and even begun to recover as the market found some footing. We closed the year well above our starting point and well ahead of benchmarks, proving the resilience of our strategy. The ability to rebound from downturns, as we did post-March 2022, as we started late in 2022, post-March 2020, and as we started in late March 2022, underscores that the fund maintains strength through crises, positioning us to continue thriving as conditions improve. In summary, World Engine achieved stability and achieved strong absolute and relative performance with a volatile but upward trending journey. We navigated market cycles and ended on a high note versus our objectives. Following, I will break down the risk and return characteristics and provide a quantitative analysis to show how effectively we manage the trade-offs between the two. Beyond the headline returns, we conducted a detailed analysis of the fund's return distribution and risk-adjusted performance metrics. It helps us understand the quality of our returns and the volatility investors endure along the way. Over the 72-month period from January 2017 until December 2022, the average monthly return of the portfolio was approximately 1.21%, and the median monthly return was approximately 1.66%. This positive skew between mean and median indicates that, more often than not, monthly returns were solidly positive, a good sign of consistency. The standard deviation of monthly returns was around 5.9, which translates to an annualized volatility in the low 20% range. For context, the S&P 500's annual volatility is typically around 15% in that same period. So our portfolio did exhibit higher volatility than the broad market, which is expected, given our growth tilt and beta, about 1.3. However, a 20% annual volatility is still moderate. It's still moderate and manageable range for an aggressive equity strategy. It wasn't arbitrarily risky, just somewhat above market volatility. Looking at the shape of the return distributions, we calculated the skewness to be about negative 0.23, indicating a slight tilt towards more negative outlier months than positive ones. In plain terms, that means we had a few more sizable down months than we had up months, which is common in equity portfolios. Market drops can be sudden, whereas gains accrue a bit more gradually. It's like taking the ladder up and the elevator down, essentially. That's the old saying. The ketosis was 0.022% positive, very close to zero, suggesting a distribution of returns that had only mild fat tails. We did experience extreme months on both sides. The single best month return was 18.3%. This likely occurred during a sharp rebound rally, possibly during the 2020 period when tech stocks exploded upward. And our worst month was negative 30.5 during 2020 in March during the COVID crash. These figures show that while the portfolio could swing significantly in a given month, these swings were within a range that our diversification meant to contain. We never had catastrophic monthly losses beyond 14%, which indicates even in extreme stress, the portfolio's mix provided some floor. Considering the risk-adjusted performance metrics, as investors, you are, of course, interested not just in raw returns, but in how much risk was taken to achieve those returns. One of the following measures is the Sharpe ratio. Over the 6 years, our portfolio Sharpe ratio was approximately 0.73, assuming a near zero risk-free rate for that period. In comparison, the Sharpe ratio of the S&P 500 was 0.6 over the same time frame. A higher Sharpe ratio indicates a better return per unit of volatility. This is a strong result. It implies that World Engine Fund was more efficient than the market in converting risk to reward. We deliver outsized returns, not simply by taking an outsized risk, but by taking smart risks that paid off disproportionately. We also looked at the Sortino ratio, which is similar to the Sharpe, but only penalizes downside volatility. It focuses on harmful volatility only. Our Sortino ratio was 1.90, indicating a very good downside protection relative to returns. Any Sortino above 1 is generally considered strong. It means that the portfolio generated over 1 unit of return for each unit of downside risk. This high Sortino reflects that while we had volatility, much of it was upside volatility. That the really harmful downside moves were less frequent, or less severe in the context of returns achieved. For a high growth portfolio, to have a Sortino above 1 is an excellent outcome, showing our risk mitigation via defense stocks work to limit the downside deviation. Another metric, the Traynor ratio, which measures per unit of market systematic risk, came in at roughly 0.148 for our fund. Traynor uses the portfolio's beta as the denominator. By comparison, the S&P 500's Traynor is the market sharp times its own volatility, effectively lower in this case since our returns were higher. Our positive alpha and moderate beta drove a healthier Traynor, underscoring the effective use of systematic risk. In simpler terms, for each unit of market risk we bought, we got a higher amount of excess return. Now, in terms of actual drawdowns and tail risks, as discussed, our minimum drawdown from peak to trough was roughly 4.86 during the 2021 to 2022 period. This is a significant drop, no doubt. But let's contextualize this. A hyper growth portfolio like ARK fell much more, 70% from its peak during this period. Even the NASDAQ index 100 saw a drawdown of over negative 30% in 2022. So our roughly negative 48% at worst, while painful, was a consequence of our pursuit of high returns. Importantly, it remained well above the losses experienced by more speculative partners. We had built in enough defense and quality tilt to avoid the absolute worst case meltdown. Additionally, the speedy recovery matters. After the market March 2020 crash, for example, we rebounded within months to new highs due to our tech allocations. Similarly, by late 2022 into early 2023, the portfolio was stabilizing off its lows, indicating resilience. We also quantify tail risk via VAR risk. At 95% confidence level monthly, our analysis showed a VAR of around negative 8.5%, meaning that 9.5% of the time, our monthly losses should not exceed 8.5%. The conditional VAR, CVAR, which is the average loss in that worst 5% tail, was approximately negative 12.9% monthly. These figures align with what we saw. Indeed, our worst month was negative 13.5, so that checks out. Essentially, in a typically extreme scenario, the portfolio might lose 8 to 12% in a month, which is within the tolerances for an aggressive fund and indicates controlled tail exposure. We didn't have a scenario where, say, half the portfolio was wiped out in 1 month. Our risk controls and diversification prevented that kind of catastrophic tail event. To visualize how our risk and return profile compares, we presented a radar chart on the slides, which provides a holistic view of the various metrics standardized for comparison. This chart highlights that World Engine's portfolio scored very strongly on return-based metrics like the Sharpe and Sortino ratios, while showing a relatively modest reading of tail risk and drawdown given its high return. The shape of the radar plot is telling. It confirms that we achieved a desirable balance, high returns, high risk to reward, and tolerable downturns. In summary, our investors enjoyed exceptional returns with a level of volatility that was managed and compensated by those returns. The risk we took was intentional, and importantly, it was rewarded. When we look at our CAP-M regression, our performance through the lens of classical financial models further illustrates how our returns were achieved. We performed a CAP-M regression of the portfolio's excess returns over the risk-free rate against the market's excess returns. These results gave us the portfolio's beta and alpha and the capital asset pricing model context. The regression showed a beta of approximately 1.32. This confirms what we anticipated. The portfolio had a higher sensitivity to market movements than a broad index. A beta of 1.32 means that historically, if the market was up 1%, our portfolio tended to be up about 1.32% on average, and vice versa on the downside. This elevated beta comes from our heavy allocation to high beta tech stocks. It's actually a testament to our strategy. We knowingly took on more market risk in pursuit of better returns. The beta of 1.32 quantifies that our portfolio was about 32% more volatile than the market due to its composition. Unfortunately, the CAPM alpha we obtained was positive. We found a monthly alpha of roughly 0.10%, 0.1% per month. While this might sound small, over 72 months, this compounds significantly. It translates to about a 1.23% annualized basis of excess returns beyond what the CAPM predicts for portfolio within our beta. In other words, given a beta of 1.32, CAPM would expect a certain return, basically a bit more than 1.32% times the market's return. Our portfolio actual returns were higher by 1.2% per year than that expectation. This indicates that we delivered alpha outperformance, not only explained by market risk alone. It suggests that skillful stock selection and timing, or the specific advantages of our theme, contributed to returns above and beyond simply riding a high beta exposure. The R-squared of the CAPM model was around 0.37, meaning that about 37% of the variance in our portfolio's returns was explained by the movements of the overall market. This relatively low R-squared highlights the diversified and idiosyncratic nature of our strategy. A lot of our performance came from stock-specific factors or sector-specific examples. For example, the unique drivers of the semiconductor industry or China's tech stock movements, etc., rather than the market going up or down. This is a positive sign for active management. It implies that we weren't just leveraged to bet on the S&P. We had unique exposures that the market index alone could not account for. In summary, CAPM analysis tells investors that, yes, we took above market risk, the beta exceeding 1, but we also delivered above market returns for that risk, a positive alpha. This portfolio wasn't simply high beta, high return. It was high beta plus smart allocation, high return with alpha. This is a hallmark of a successful active strategy. Examining the multi-factor, to further dissect performance, we extended our analysis to Fama-French multi-factor models, both the classic 3-factor model, market, size, and value, and the 5-factor model, adding profitability and investment factors. This helps determine if our returns can be explained by 9-style factor exposures or if they were truly explained by unexplained alpha. The factor loadings we obtained aligned with our portfolio's characteristics. We had a positive loading on SMB, small minus B, of 0.27%, which indicates a tilt towards smaller cap stocks on average. This makes sense. Whilst many of our holdings are large cap, for example, Microsoft, Google, we also included many mid-cap names like LT Harris or Textron, and even a couple of relatively mid-sized tech firms like AMD, which was mid-cap in its early years, for instance. A 0.27% SMB suggests a moderate bias to mid to smaller companies compared to purely large cap index. We showed a strong positive loading on HML, high minus low, of negative 6.4%, 0.64% rather, negative 0.64%. In Fama-French terms, HML represents the value factor, high book to market minus low book to market. A negative loading means our portfolio behaved like a growth-orientated portfolio. So low book to market stocks, e.g. growth stocks, did well in our portfolio. This isn't surprising. We intentionally picked growth stocks, like tech within tech and digital platform companies tend to have higher valuations and low book values relative to the price. The magnitude, negative 0.64, is quite significant though. It indicates a heavy growth trend. Essentially, if value stocks outperform in growth, our portfolio likely lags somewhat, and vice versa, which is exactly what happened in some periods, e.g. for example, late 2022, growth far outpaced value, benefiting us, whereas parts of in late 2020, growth far outpaced value, benefiting us, whereas parts of 2022 saw a value resurgence, which was headwinded for us. The load on RMV, robust minus weak, which captures the profitability factor, was 0.015. This suggests that we had a slight bias towards companies with robust profitability. Many of our tech holdings are highly profitable, Microsoft, Alphabet, and even Meta, which largely drove this positive RMW. Others, like early-stage growth firms, might not be as profitable, but on balance, we lean towards companies generating strong earnings or cash flows, especially on the defense side, which are all profitable firms. A 0.5 is not a huge RMW, but does indicate some preference for quality companies in terms of earnings strength. For CMA, conservative minus aggressive, the investment factor we had was 0.32 loading. A negative CMA means our companies tended to be more aggressive in reinvesting and growing rather than conservative about investment. This aligns with our theme, high growth tech firms typically reinvest in heavily in R&D and expansion. Think of NVIDIA pouring millions, billions even, into its new chip designs, or Meta investing into the metaverse. Defense firms also invest in new technologies and contracts, even though they're a bit more conservative. Overall, the portfolio leans towards companies that invest for growth, which is consistent with our growth portfolio standards. So the negative 0.32 confirms an aggressive growth stance in terms of capital deployment. After accounting for these factor tilts, we look at the alphas in multi-factor models. Remarkably, World Engine's portfolio continued to exhibit significant positive alpha. In the FAMA French 3-factor model, our annualized alpha was on the order of 7.7, which corresponds to about 0.62 per month, not explained by the market, size or value factors. Even when we expanded to the 5-factor model, capturing value, size, profitability, and investment, the annualized alpha was around 7.2, roughly 0.58 per month. These are very robust alpha figures, indicating that even after stripping out returns and attributable factors to exposures like our growth tilt or size tilt, we still generated over 7% per year of excess returns due to stock specifics or timing specific advantages. To put it simply, our strategy added value beyond simply being a portfolio of large growth tech and defense stocks. Of course, the factors explained a good chunk. For example, our negative HML helped a lot in the years when growth beat value, but the remaining alpha suggested our active decisions, which stocks we picked within those themes, when to hold them, made a more meaningful difference. We weren't just hugging a factor profile. We selected unique names, like mixing a Chinese tech giant or a consulting firm like Booz Allen alongside pure defense. That's what gave us an edge. The portfolio's alpha remained positive and high, which is a key measurement of success in active management. What does this mean for investors? It means that the fund's outperformance wasn't merely a byproduct of being right in a way, or being in the right style. Growth stocks did well, defense did not. Okay. Rather, it indicates managerial skill and validity in our investment thesis, even controlling for styles and factors. World Engine delivered excess returns, confirming that it achieved persistent alpha generation. Diversification was a key cornerstone for our risk management, and our correlation analysis of the portfolio's holdings reveals how effective our barbell approach was in practice. We computed the correlation matrix of the returns of our portfolio constituents to see how closely they moved together. Overall, the average pairwise correlation was around 0.41. In an equity portfolio, an average correlation of 4 indicates decent diversification. It means that our stocks are all part of the equity market, so they're not uncorrelated from each other. They're far from it. They are in lockstep, rather. There was meaningful dispersion. Different stocks responded differently according to various factors, which is exactly what you want when mixing different sectors. We observed that correlations were higher among stocks within the same sector or theme, and lower among the barbell with tech and defense stocks. For example, among our mega cap names, correlation was quite high between Microsoft and Google. They had a correlation of about 0.72, reflecting that they were influenced by similar macro and industry forces: global economic growth, digital spending, cloud demand, etc. This isn't surprising. These two companies often move together with market sentiment on big tech. Similarly, our defense contractors, L.T. Harris and Northrop Grumman, showed a correlation of around 0.7, since both responded to defense budget use and geopolitical events in similar ways. These high correlations within each cluster indicate that, yes, the stocks in the same bucket will behave alike, which is why they simply hold many tech stocks. Holding many tech stocks doesn't diversify much, and likewise for holding multiple defense stocks. However, when we look across the two clusters, growth tech versus defense, correlations dropped dramatically. For instance, with Alibaba, a Chinese e-commerce and tech giant in our portfolio, had low correlation with our US defense names. In one pair, for example, Alibaba and Northrop Grumman, the correlation was roughly 0.08, essentially near zero. This means that Alibaba's returns almost had no linear relationship with Northrop's returns during the period. They were driven by completely different factors. Alibaba by Chinese consumer trends and tech regulation, and Northrop by defense spending and war headlines. Likewise, many of our tech holdings had low correlations with our defense holdings. When tech stocks were surging on earnings growth, defense stocks might have been flat or modestly up. And when tech stocks plunged due to interest rate fears, defense stocks might have been climbing. This negative minimal correlation between the two halves of the portfolio is exactly what provided our downside protection in tough times. The correlation matrix thereby confirms the success of our barbell diversification strategy. We achieved a blend where not all eggs were in one basket. The tech side and the defense side often counterbalance each other. During the COVID crash, for example, everything fell initially, but in the recovery phase, tech exploded upward much more than defense did. During the late 2021 inflation scare and into 2022 with the Russian and Ukraine invasion, tech struggled while defense stocks held their ground or rose. This interplay smothered our overall returns. The portfolio's volatility was lower than it would have been if we only held one of these groups. To put it qualitatively, where one side of the portfolio zigged, the other zagged. Our growth names provided the engine of high returns in bull markets, while our defense names provided a stabilizing force in bear markets or during shocks. We effectively paired growth with stability and low correlations, and the low correlations between those positions empirically delivered the benefit we sought of volatility smoothing and risk reduction. In practical terms, this meant that at the portfolio level, we never had a situation where every single holding was down severely at the same time. Even in March 2022, for instance, defense stocks likely fell less and rebounded faster with government stimulus and continued support than defense stocks, than tech stocks. In the tech wrap of 2022, defense stocks were actually going up, offsetting some losers. Diversification doesn't eliminate risk, but it redistributes and reduces concentrated risk, which our correlation data demonstrates. Thus, from a risk management perspective, we are pleased that the portfolio achieved a moderate inter-portfolio correlation of 0.4. This negative of 0.4, right? This indicates a thoughtful spread across different drivers. This gives us a more reliable performance outcome than a one-dimensional bet, without compromising the high return potential. In summary, our diversification was real and beneficial. It wasn't diversification for its own sake, but rather targeted diversification, aligning with our themes, tech and defense, that paid off by buffering our portfolio during adverse conditions. Our success was rooted in how we tactically allocated sectors and themes, which was a deliberate reaction to our convictions. I'd like to describe our sector positioning in terms of how each segment contributed to our portfolio's risk. Technology and semiconductors was strongly overweighted. This was the growth engine of the world engine. We devoted a large portion of the portfolio to tech, especially semiconductors and tech-related companies. At its peak, roughly half of the portfolio's value was only in a handful of names. The high concentration meant that, effectively, the tech segment's influence dominated in bull markets. You can think of this segment as having its own portfolio beta. In fact, if we isolate our semiconductor holdings and AI tech stocks like NVIDIA, AMD, and Intel, plus our big tech softwares like Microsoft, Alphabet, and Meta, their combined effective technology beta was around 1.68 relative to the market. This high beta segment was intentionally overweight because we had a high conviction that these sectors would outgrow the market, and they in fact did, fueling the portfolio's outperformance. The flip side is they introduced volatility. But as discussed, we addressed that with our hedges. Our overweight to semiconductors in particular was a tactical call that paid off enormously during the 2019 to 2021 period as demand for chips soared for data centers, crypto, etc. Even though 2022 was hard for this group, the multi-year gains far outweighed the temporary pullback. In essence, the tech overweight delivered the lion's share of our returns and validated our thesis that tech and digital transformation are long-term, secure growth drivers worth the risk. Defense and aerospace were low beta stabilizers. We maintained roughly a quarter to a third of our portfolio within the defense and aerospace companies, which was a much larger allocation to this sector than a typical equity fund. This was our second tactical overweight. The reason was twofold. We anticipated rising geopolitical tensions and defense spending, which indeed materialized. Unfortunately, through events like increased global conflicts, we wanted a low beta counterbalance to tech volatility. The defense sector has a different risk profile. As noted, collectively, our defense holdings had a beta of around 0.87 to the market. They tended to have stable government contracts, strong cash flows, and some dividend yields, making them behave a bit like value stocks. This part of the portfolio did not shoot the light out in returns the way tech did, but it did deliver steady gains. Northwick's price increased by 137%, for example. And crucially, it protected the portfolio when tech faltered. Essentially, treated defense stocks. We essentially treated defense stocks as an insurance policy that could profit from any surge in demand due to global events. This paid off particularly in 2022. While our tech side was down, our defense side was flat to up, saving overall performance. Our tactical overweight here was a key differentiator from pure tech funds and proved its worth in risk-adjusted terms. We also sprinkled in exposure to global macro tech trends, primarily through Alibaba, as our window into the Chinese tech economy, which brought us diversification by geography and business models. Although Alibaba had its ups and downs, regulatory crackdowns in China affected this. Holding it meant that we participated in China's boom, China's tech rise, and also had an asset that could behave differently from US stocks based on China's economic cycles. This aligns with what we noted in correlations. Alibaba was an outlier in terms of not being correlated to others. So from a macro standpoint, we made sure the portfolio wasn't entirely US-centric. It could benefit from the growth in another major economy, and also hedge against purely US phenomena. In summary, our tactical positioning can be seen as three-pronged. Aggressively overweight towards the high-growth tech sectors to drive returns, meaningfully overweight towards the defense and aerospace sectors to provide protection and benefit from geopolitical trends, and also includes selective global communication names to diversify exposure and capture a broad set of growth drivers, from US enterprise software to Chinese commerce to social media. This positioning was not static. We consciously monitored and rebalanced weights to ensure we remained to our true strategy. For instance, as NVIDIA grew to a larger position due to price performance, we occasionally trimmed and reallocated to maintain prudent weights. As macro conditions evolved, we stood steady to adjust through. In practice, we held through volatility, which ultimately was rewarded. The outcome of these tactical choices is evident. The technology side gave us market-beating growth, and the defense side gave us resilience. By having the conviction to overweight these areas, we deviated from the benchmark significantly. That active risk paid off well in active return. In a case study in how a centered and thematically driven allocation can outperform a more traditional diluted portfolio. In conclusion, World Engine's portfolio decisively met and exceeded its original objectives. We set out to outperform the S&P 500 with the high-growth strategy while managing volatility. And over the 2017 to 2022 period, we delivered on that promise. The fund achieved a total return of roughly 219%, vastly outpaying those S&P 500 72%. In the same period, and outperforming other comparative innovation and defense funds. This performance was not a smooth straight line. It came with its periods of rapid gains and rapid periods of drawdown. But over the full horizon, our investors were rewarded with market-beating growth. We demonstrated that our hybrid investment model works. Blending aggressive growth with stable defense in a concentrated market portfolio provided an optimal risk-reward outcome, even after accounting for various risk factors. The portfolio showed persistent alpha, indicating genuine outperformance due to our strategy and execution. We effectively harnessed the major transformative trends of our time: cloud compute, digital platforms, semiconductors, and buffered those with geopolitical hedging through the defense sector and international markets to navigate crises. The result was strong, absolute returns and superior risk-adjusted returns, as evidenced by our Sharp, Satina, etc. Importantly, the fund remained resilient during market stress, recovering quickly from the 2020 pandemic shock and withstanding the 2022 inflationary shocks, better than pure growth plays, which speaks to our robust risk management and allocation decisions. Now looking forward, a key question is, should the fund and strategy continue? Given the success today, we believe it's an easy answer: yes. With some considerations, the thematic tailwinds behind World Engine remain intact and indeed may escalate further. With the development of artificial intelligence and semiconductor advancements, if anything, even more central to the global economy today than 6 years ago, we can expect tech, automation, AI, and digitalization to drive growth in the tech sector for years to come. Our core tech holdings like Microsoft, Nvidia, Alphabet, etc., are leaders in these fields and are well positioned to capitalize on these trends. Meanwhile, the defense sector, unfortunately, operates in a world with ongoing tensions, from conventional geopolitical rivalries to new domains of cybersecurity and space. The need for defense modernization and spending is not going away anytime soon. If anything, the past few years' events have reinforced the importance of having exposure to this sector. So the fundamental rationale for our barbell, innovation plus defense, is still very much valid. However, we must acknowledge the changing macroeconomic environment we are in now. We are in now a period of higher interest rates and tighter liquidity as central banks combat inflation around the world. This is a different backdrop than the mostly low rate environment of 2017 to 2022. That was a favorable environment towards high growth valuations. Going forward, we may frequent more rotations in the market. For instance, investors may favor value stocks or income stocks in rising rate setting, at least temporarily. This means that our high growth positions can see more valuation volatility in the short term. To address this, our fund will continue its active management approach. We will monitor our exposure and we will make tactical adjustments. For example, trimming positions that become overvalued or increasing defense hedges if needed to navigate the new regime. This is good news in our strategy. Our defense stocks tend to do relatively better in inflationary conditions and rising rate environments, as seen in 2022. So we already have a partial balance, but we will remain vigilant about risks like monetary tightening, supply chain challenges, and any new geopolitical developments that could impact our holdings. In conclusion, the past 6 years have shown World Engine strategy as a viable and effective approach to growth investing with risk mitigation. We achieved what we set out to do and more. Our fund's performance through multiple market cycles has validated our investment philosophy. We believe that the fund should continue with its core strategy as the underlying themes are long-term in nature. By remaining undisciplined yet adaptable, we aim to carry this success forward. We will, of course, keep a close eye to macroeconomic signals and be ready to rebalance if the environment calls for it. But our commitment to the dual themes of breakthrough technology and defense resilience remains firm. To all of our investors, thank you for your trust and support throughout this journey. We are proud of the results that we have delivered for you, and as we move forward into the next phase, we do so with the confidence that World Engine Portfolio is well positioned to continue generating attractive returns while prudently managing risks. Thank you for your time today, and we look forward to the fund's future progress and updating you about it.